Hello. I want to talk a little bit about inventory valuation methods. So let me go ahead and share the screen. Okay, so I've got an Excel file here, and want to talk about a couple of things again. Inventory valuation. How do companies value inventory? Now, for one thing, inventory is basically goods that are being held for sale, such as you walk into a Walmart and you look around and there's all these goods there that you could purchase. That's inventory. So inventory would be something that a merchandising company would hold to sell to their customers. Now, a couple of terms here. A perpetual inventory system would be one that is updated regularly as new inventory comes in or as items are sold. It's updated on a regular basis. This is what most companies use, and in the examples that we look at in just a moment, this is the kind of inventory system that's going to be in the examples we look at. Now, a periodic system, this would be an inventory system that is a little more old school. It's basically what a company, if they use this, what would happen is they would put everything to purchases, like everything that they got in during the period of purchases. They would have a beginning inventory and then their purchases. They would have to count inventory at the end of the period to determine how much they've sold and to determine what their cost of goods sold was for the month. How much they've sold and what they've got left, basically. So periodic, not used as much anymore. Still kind of a hybrid method, maybe used somewhat with some grocery stores, but not used as much. Most people use perpetual since systems are able to update things on a regular basis as new items come in, as items are sold. Now, you've got another thing here called FOB. Now, FOB stands for free on board. And basically, whatever comes after FOB is when title is transferred in the case of a sale. So if you have FOB shipping point, then title would be transferred once UPS or Federal Express picks it up from the seller's location. So during shipment, the buyer would own the inventory. Now, if it says FOB destination, then basically the seller would own the inventory during shipment, and title would not transfer until it reaches the buyer's business or destination. So you'll see more about this also probably when you take business law, because a lot of legal precedent has been set around, okay, something was lost, something was damaged, who owned it? And so you'll probably see this again at that time. Another kind of term to consider here related to it is consignment. Now, one thing to remember about consignment is where the seller sells goods for someone else on consignment. If many of you have been to a consignment sale before, whoever's holding the sale, other people own the inventory. And basically the consignor is just selling it. One thing to remember is goods on consignment are only inventory for the company that owns them, not for the company that's doing the selling. So just something to keep in mind. Also, one other thing, damaged inventory is basically sold at net realizable value. So what that means is that if inventory is damaged, it's going to be marked down to whatever it's worth. So if someone basically say was selling, let's say a refrigerator, and it was worth about $1,000, they were going to sell it for $1,000. But let's say it got dropped off the truck and dinged up pretty good. And so now they only feel they could sell it for $300. They would write its value down to $300. So any damaged merchandise would be lowered to whatever the company feels like they can sell it for, whatever it's worth in the marketplace. Now, so a couple of things here. I want to talk about this term here first. And so what we're going to kind of discuss, or kind of the main thing we're going to discuss here, is what is the value of inventory? What is the value of inventory? Now, or how do you value inventory? Now, one thing to think about here is if you sell goods where you can specifically find out what type of product the type of product um, by basically the make or the model or the SKU number. So if you sell a product like that, you can use what's called specific identification to value your inventory. So CarMax, for example, CarMax, they sell used cars. So at any time, CarMax can pull a report and it should have the make, the model, the VIN number of every car on their lot. So they could use specific identification because they can specifically identify what's there. They can specifically identify what's been sold. Jewelry stores tend to use this method too, because a jewelry store basically should know, like if it's a very expensive watch or the grade of a diamond or the cut of a diamond or gold, whatever they've got, they should be able to specifically identify what they're selling. So specific identification just means that you specifically identify the unit that's sold, you specifically identify what's still there. Specific identification tends to be good with very large dollar value items. So if your inventory tends to be very large dollar value specific items, then specific identification is great. Now, what we're going to look at though is what if your inventory items are all the same? What if you've got 100 boxes of Tide on the shelf and they're all the same? They're all going to have the same SKU number and they're basically all the same. Now, what if that 100 boxes of Tide you've got out there for sale on your shelf has come in over the last couple of months as part of 3 different shipments, and you've paid a little bit different price for every shipment? Then how do you account for which one was sold and what's the cost of that item that was sold? So that's what we're going to look at today. So there's going to be 3 methods we're going to look at as to how a company can handle this. And one thing I want to say up front is there's no way to really know which box of Tide they're taking that's being taken out when a customer buys it. But the 3 methods we're going to look at are just simply ways that companies have to account for their business when this is the case with their inventory. So companies can choose either of these 3 methods. They need to be consistent with their choice. And again, these aren't necessarily what's been taken off the shelf, but it's just companies have to choose a way to account for inventory whenever in this consideration. So the first method we want to look at is called FIFO. You'll see it here. It's FIFO, and it's called first in, first out. And basically what FIFO means is that all sales are going to be taken out of the oldest items of inventory first and move their way forward. So FIFO, first in, first out. The oldest items come out of inventory first when making sales. So this is the data that we're going to use. And basically, you notice I've got a column here. I've got this column here for purchases. So this is going to kind of represent the number of units, the price per unit, the total for that purchase. Then I've got sales right here. I've got the dates, of course, right here. And then this is going to kind of be the running inventory balance. So we're going to look at all 3 of these methods, FIFO being the first one, first in, first out. And then we'll look at the other 2 as well. We're going to use the same group of information for all of them. So let's look at this one first. So under FIFO, of course, at the beginning of the month, we've got a beginning balance, and that would be 100 units at $10 each for a total valuation of $1,000. Now, we have our first purchase on basically January the 5th. And so now we have the original 100 that we had plus the 111. So now we've got 200 units in inventory at a total value of $2,100. That's basically what we've got right now. Now, on January 10th, we basically make our first sale. So notice that we're going to sell 150 units on January the 10th. So since we're doing first in, first out FIFO, that means we're going to start with our oldest items. We're going to assume that those are the items that are coming out in the sale, and we're going to move our way forward. So the 150 items, the first 100 would be taken out of the oldest items in inventory that we had. And then the other 50 would come out of this latest group. Again, FIFO, first in, first out. Sales come out of the oldest items in inventory and work their way forward. So after this sale is complete, notice that we still have 50 at 11 for a total value of 550. Now, one other thing I want to help you, and you can really apply this to any of the methods that we're looking at, is notice that the available inventory before the sale is either sold, you see 1,550 of it was sold, or still in ending inventory. You see 550 here still in ending inventory. So whatever you had that was available before the sale, after the sale is either sold as part of cost of goods sold or is still in inventory. So these three will always equal. After every one of these after every sale, that's always going to equal. So that's just kind of a check figure for you. So let's go on. On January 15th, we make our next purchase. We purchase 100 items, $12 each for a total of $1,200. So now we've got the initial 50, plus we've got 100. So we've got 150 units with the total valuation of $1,750. So this would basically be where we're at right now. So we have 150 units in inventory, total valuation of $1,750. Now, on January 20th, we make a sale. We're going to sell 100 units. So since we're doing FIFO, basically it's going to come out of the oldest first. So we're going to take it out of this 50 at 11. That's the oldest item we had on hand. And then the other 50 is going to come out of the newest. And so we sold 100. Our cost of goods sold for this sale would be $1,150. Now, notice what we've got left. After this sale, we've still got 50 left in inventory, $12 each for a total value of $600. Now, if we wanted to find out our total cost of goods sold for the period, we would just take the cost of goods sold from the first sale plus the cost of goods sold from the second sale, add them together. That would be our total cost of goods sold for the month. So one thing I'll say is that whichever of these three methods that we're looking at here, whichever one they choose, what a company is really trying to verify here is what is the amount of their cost of goods sold based on their sales, and what is the value of their ending inventory. Now, remember cost of goods sold. This is the cost of the goods that they sell. This is what it costs them. And ending inventory is just the value of whatever inventory is left. Now, so that's one method, FIFO. Let's look at the next one, LIFO. LIFO is just the opposite of FIFO. LIFO is last in, first out. And what LIFO does is it's going to take sales out of the newest items and work its way backwards. So LIFO, last in, first out, basically sales come out of the newest items to come in and they work their way backwards. So let's go ahead and look at this. Notice that, again, all the numbers we're using this time are the same ones we used in the first example. So notice everything starts off the same with beginning balance, with our January 5th purchase, everything is the same. Now, we make our first sale again on January 10th, and we sell 150 units. So selling 150 units, basically is where we're at now, is basically selling 150 units. So under LIFO, what does that come out of? So It would be basically, we would take it out of the newest items to come in first and work our way backwards. So notice the first place it comes out of is the last items to come in. This 100 at 11 for 1100. And then the rest of it we take out of, we just start at the first one and then work our way backwards. So basically, our cost of goods sold for this one then would be $1,600 for this sale. So again, LIFO sales start with the newest items to come in and work their way back. Now, what's left would be 50 at 10 for 500. So 50 out of this oldest inventory would be basically what would be left then. So things are still the same here. We get another shipment in on the 15th, 100 at 12. So this is our inventory balance before we make our final sale. We've got the 50 from the beginning balance, and then we've got the 100 that just came in. So we make another sale of 100 on January 20th. And basically, since we're doing LIFO, last in, first out, basically this sale is going to be taken out of the last inventory item to come in. So we now have, so basically what we've got left in ending inventory then would be still that 50 at 10, which is from our beginning balance for a value of 500. And if we were to add up our cost of goods sold, it would be from the first sale plus the second sale, it would be 2,800. Now, one thing to note here is that notice again that there's different balances. You've got, if you know, based on which one of these methods you do, you're going to have a little bit different balances. You're going to register a little bit different amounts for cost of goods sold and ending inventory because you're using different numbers. You're using different numbers to calculate each one. And think about it this way. Over time, prices tend to increase. Like lately, you've seen price increases going up a lot. Over time, prices tend to increase. So notice that like you had cost of goods sold of 2,700 with FIFO, 2,800 with LIFO. You had ending inventory of 500 with LIFO, 600 with FIFO. So you're gonna see a little bit different numbers with each one, whichever one you choose. So these two basically kind of choose an extreme. They kind of choose one extreme or another. Now, let's do weighted average. The last one that a company can choose is weighted average. And weighted average kind of, I think the distinction with weighted average is it tends to be more accurate. And the reason it's more accurate is because it works off an average, where LIFO kind of works off one extreme and FIFO kind of works off the other extreme. Weighted average is just an average. So I think it more accurately reflects what's actually there. So we're going to use the same numbers as before. So notice that we start off with our beginning balance, our beginning inventory, 100 at 10. Then we purchase 100 at 11. So everything is the same here as the other two examples. Now, there's one thing that you're going to have to do when you do weighted average. And that is that every time you purchase new inventory or get new inventory in from a purchase, you've got to come up with your new average cost. An average cost is simply you take the value of the inventory, you divide it by the units, and you come up with your average cost per unit. You take the total value of the inventory, divide it by the units, and you come up with your average cost per unit. So that's how you come up with the average cost per unit. So then you see we make a sale here on January 10th of 150 units, just like we have in other examples. And we take that sale out, we record the cost of goods sold based on the current average cost. And so basically 150 times 1050, which is our current average cost, gives us a cost of goods sold for the sale of 1,575. Whatever inventory is left, we take it times the current average cost to basically, again, give us the value of the ending inventory that's still left. Notice we could take the but notice we could test this also with this, that all the inventory that was available for the sale is either sold, cost of goods sold, or is still there. Notice again that these three equal, just like in the other examples. So we're going to make another purchase here, again, on the 15th, 100 units at 12 for $1,200. And so notice you've got basically your initial inventory based on your initial average cost, and then you've got new inventory coming in, the 100 at 12. So again, every time you get in new inventory, you have to refigure your average cost. So in this case, we would take the total value of the inventory, divide it by the units, and you come up again with an average cost of $11.50 per unit. So we make our last sale again on January 20th. So we would take the 100 units times $11.50 per unit, and we would get a total value of $1,150. So this would basically be the total value of this would basically be our total cost. Our total cost of goods sold would be these two added together, the cost of goods sold from the first sale and the second sale. That would be our total cost of goods sold. And then the value of our ending inventory would just be the units that are left times our average cost would give us the value of what was left. Now, one thing to notice with this is that, again, you remember how earlier I showed you that there's a difference between cost of goods sold, between FIFO and LIFO, and ending inventory, between FIFO and LIFO. Notice that average cost is somewhere in the middle. Notice that it's in the middle as far as cost of goods sold and the value of ending inventory between the two. So one thing to note about it is that LIFO kind of takes one extreme, FIFO kind of takes another extreme. Weighted average is somewhere in the middle. Now, the advantages of each method. Let me just say the advantages of each method real quick. The advantage of FIFO is that it tends to give you lower cost of goods sold, which will give you higher net income. So FIFO will tend to make you look a little better financially when prices are increasing, which they normally are. LIFO, on the other hand, since it's higher cost of goods sold, will give you lower net income, will save you a little bit on your taxes. So more companies actually use LIFO than FIFO because they would prefer to save the money on their taxes. Weighted average is somewhere in the middle. Like I said, weighted average kind of has the advantage of probably being the most accurate method of all of them. So weighted average is really growing in usage by companies because as technology gets better, they can figure more things related to weighted average with their systems. So remember, a company has to choose one of these three methods, and they don't change very often. Typically, they take one and stick to it unless they can prove that there is a very, very good reason for a change. Otherwise, they'll take one and stick to it. They can't just every year decide to do whatever suits them. I think it's better for us to do weighted average this year. They can't do that. They've really kind of got to get one and stick with it for consistency of financial reporting over the years. So this is a basic example, but a good example of what you would do valuing inventory based on LIFO, FIFO, and weighted average. So thank you. And get with me if you have questions.